True, but a lot more stocks to discuss. So let's get in Harendra Kumar, MD at Elara Securities, who joins us on the show. Hi, Harendra. Good morning. Thanks so much for joining in. Well, let's focus on Z because that could be one of the top stocks in the first few hours of trade. News that came overnight is SEBI has barred a couple of their top executives, including Mr. Puneet Goenka, which as of the merger, details of what was put out was that he'll continue at the helm. How do you approach the stock? It's likely to pull back today. Do you think they will appeal to SAT, things will get sorted out, they'll find an alternative, and ultimately the merger goes through? So in that case, you look to buy into it? Or do you think, let's wait for clarity and only then get it?
Okay, I think beyond the event per se, I think let's take a step back and see fundamentally why would anybody want to buy Z? I think people were looking at Z is obviously subsequent to the potential merger with Sony. There'll be a lot of synergistic benefits that will flow into the company, and they'll be able to synergize, cut cost, add profit. That's one. And second is, of course, there was significant value in the stock given at the market cap that it's trading at with respect to the historical numbers. So these are the primary drivers. Now in this, towards this end goal, the NCLT clearances, the approvals from various regulatory bodies, where the intermediate steps to that end outcome, all right? And what the market is currently seeing is a lot of hiccups towards that end outcome. So now the bets are whether such an outcome, or that merger will play up successfully or not. So if you ask me, you're an investor who's a value trader and is eventually has time on his side and believes that over the next 3 years, these are very short-term hiccups and everything will be hunky-dory, then obviously every dip will become a good opportunity to buy into, right? But if you believe that you're a tactical trader, I don't think this is the time to enter. So I think that's the way you need to trade. With respect to the order, I'm sure, and it's all in the code. So there will be an appeal, and there will be a sufficient defense to every order that will come, and rightly so. So that's how we'll trade. But I think beyond this, especially in the media space, if you're looking to trade, if you think that FMCG, which has got the margin tailwinds on its side, is going to bump up its marketing and advertising, then a short tactical trade to that extent will be Sun TV. Mind you, I use the word short tactical trade. So over the next 3 to 6 months. So if you're not actually looking to trade Z, I think there are alternatives available within the space for the similar opportunity.
Okay, so but for Z particularly, do you think all of this could impact the merger? I mean, in terms of either a timeline or the execution of the merger?
So I'm not sure at this given point of time because these are all moving variables, and to pinpoint and say that this will work in your favor, I think it's a difficult statement to make at this given point of time.
Okay, all right. Yes, there are a lot of imponderables, especially with the news flow changing by the hour for Z and Sony. Got that. All right. Wanted to move forward and talk a little bit about the auto stocks because there's been a big rally over there. But this morning, CLSA has actually downgraded Hero MotoCorp, saying that a lot of the good news is in the price, and there's a lot of competitive intensity as well now with a slew of new launches even in the EV space. What do you do if you own auto names, especially the two-wheelers?
Oh, actually, we are fantastic. We are very bullish on the auto space. I think over the next 3 to 6 months, the auto space will outperform some of the other sectoral indices. I think it comes with 4 or 5 large tailwinds. One is the softening of raw materials. Second is that the interest rate tailwinds is yet to creep into the consumer buying, right? And there is an imminent rural recovery which is under play. These are large structural tick points, which makes us absolutely optimistic about the auto space. Now within that as well, you have the CV cycle, where people are expecting that it's topped out. In fact, we believe that there's a multi-year sectoral CV cycle that is under play, given that the fleet operators will go through a replacement cycle. So we are not worried on the auto pack. In fact, we are overweighting the auto pack. And within that, of course, you should have the PV plus CVs as your first pecking order, and then you could go to two-wheelers. In two-wheelers, I think Hero is demonstrating significant gains and retail sales at the given point of time. Valuation is also in its favor. So I think there are more legs to this rally at this given point of time. and yet I would say premature selling would work adversely in the favor of the investor, against the investor.
All right, Harendra, I request you to please stay with us for a bit. We're just inviting our first corporate on the show.
Well, Harendra Kumar of Elara Securities is still with us. Let's get a view going from him. Harendra, you know, in the last fortnight, actually last couple of months, there is a return of a lot of the platform stocks, right? Whether the platform companies, whether it's Zomato or even delivery, Nykaa has come back a tad bit, Paytm as well. Do you have any stake here? I mean, do you like these stocks? And from an investor standpoint, is it good to go for more?
Yeah, so I think it's not a secular bucket because some of the names are demonstrating that they could achieve EBITDA break-even or PAT break-even over the near future. So to that extent, I think there is some confidence in probably Nykaa, Paytm, and possibly Zomato. All right, but there is a set of other companies like delivery, etc., where the profitability road is still with trouble and is going to take longer. So we would not treat the bucket as one secular bucket because valuations are still calibrating to the earnings trajectory of these companies. But some of them, yes, are demonstrating that in the near vicinity over the next 3 years, EBITDA break-even plus some significant growth in PAT is possible. And at that moment, they start to add value. So mind you, the investors who came in during the IPO are sitting on big losses. So they could look to add positions at this level to cut, to average their prices. But at the IPO levels, they will hit a lot of supply, given that the waiting period has happened and they need to recalibrate their position. So at best, these trades will be from current levels to the IPO position, if one wants to trade them tactically. So that's our view, at least over the medium term on this name. And after you cross the IPO levels, you'll see how the growth for the next 4-5 years will pan out. But at the moment, it's a short trade for the distance that we just spoke of.
Harendra, hi, morning. You guys do some very interesting work and deep dives, etc. What is your team most excited about, thematically speaking, in terms of what will make money from here?
I think number one is obviously the multi-year capex cycle. You just had Titagar Wagons on the show here. I think railways, though the budget has increased significantly, it's gone into a multi-year cycle. So that's one theme. It's early in the cycle now. So you have infrastructure, you have cap goods, you have power names. So there's a whole suite of names. For example, SJVN is adding 3x of its capacity over the next 7 years. Trades are on book or sub-book with regulated, return equity of 13%. Same as with NHPC, NTPC. Significant value on the renewable subsidiaries. So I think the value capture cycle for these names is yet to begin. You will also see a lot of old infrastructure names coming back. Order books are bloated. Typically, when that happens, you have a long earning cycle that comes off. Balance sheets repair itself. So that's a decadal trade. Currently, these stocks are still under-owned, so we like them.
Harendra, sorry to interrupt.
Analysis.
Sorry to interrupt. The entire IEX thing, which has happened over the last 3-4 days, does it raise question marks about these sort of regulated return entities and what may happen? I mean, does it cloud the skies a little bit in that sense, or no?
Yeah, interesting point. I think currently the market is facing a lot of, you could say regulatory assault from various kinds of companies that is adding volatility to the stocks. So we've analyzed IEX. We think that it's a storm in the teacup. We should wait it out, and I think the long-term trajectory for the stock is pretty reasonable at this given point of time. So I think especially for IEX over the long term, I reiterate, is pretty okay. Similarly because we're discussing regulatory outcomes, even for the mutual fund industry, my guess is that the trajectory of the sector is very robust. You will double AUMs in the next 4 years. So the asset managers and wealth managers are available at a significant discount to their intrinsic value here. So currently they will be hemorrhaged because of the regulatory overhang at this given point of time. But these are large structural plays. I think these are opportunities for value investors to deep dive at the moment.
All right, Harendra, just stay on. We'll come back in a bit. We have